Hello everyone, welcome to Business School 101. Have you ever heard someone say, "We're in a bull market," or "It's a bear market, watch out," and wondered what those terms actually mean? You're not alone. In this video, we'll break down what bull and bear markets are, how they impact the economy and your investments, what smart investors do during each phase, and how legendary figures like Warren Buffett have navigated these cycles throughout their careers. Let's dive into these important concepts together. Section 1. What is a bull market? A bull market refers to a period in which stock prices are rising or expected to rise. Investors are confident, companies are growing, and people are eager to invest. Typically, a bull market is marked by an increase of 20% or more in major stock indexes, like the S&P 500, over a sustained period. The name bull comes from the way a bull attacks. It charges forward and thrusts its horns upward, symbolizing upward momentum in the market. Bull markets usually occur when the economy is strong, unemployment is low, consumer confidence is high, and corporate earnings are rising. For example, between 2009 and early 2020, the U.S. experienced one of the longest bull markets in history. During that time, the S&P 500 rose by more than 300%, fueled by low interest rates, strong corporate performance, and investor optimism. Section 2. What is a bear market? A bear market, on the other hand, is the opposite. It occurs when stock prices fall 20% or more from recent highs, usually over a period of 2 months or longer. Bear markets are often caused by economic downturns, rising interest rates, inflation, or global crises. The name comes from the way a bear attacks. It swipes its paws downward, symbolizing falling prices and investor pessimism. During a bear market, investors may panic and sell off their stocks, which can push prices down even further. Consumer spending slows, companies cut back on hiring or lay off workers, and people become more cautious with their money. For example, in early 2020, the COVID-19 pandemic triggered a sharp bear market. The S&P 500 fell by more than 30% in just a few weeks, as investors feared the economic impact of global lockdowns. However, markets rebounded quickly afterward as governments and central banks took action. Section 3. What should investors do? Let's take a look at what investors should do during each type of market. During a bull market, investors should do the following. First, stay invested. A bull market is marked by rising prices and widespread optimism. During these times, it's generally smart to stay invested and let your money grow with the momentum of the market. Trying to time the perfect moment to sell can lead to missed gains. Historically, long-term investors who remained consistent during upswings enjoyed substantial returns. Second, be mindful of overconfidence. As prices climb, it's easy for investors to become overconfident and take on more risk than they should. Just because a stock is rising doesn't mean it's a good buy. Avoid getting swept up in hype or trends that aren't backed by solid fundamentals. A disciplined, research-based approach is crucial, even in good times. Third, consider rebalancing. As your investments increase in value, your portfolio may shift away from its original allocation. For example, if stocks outperform bonds, your portfolio may become riskier than intended. This is a good time to rebalance. That means selling some assets that have grown too large and buying those that are underrepresented to keep your risk and return levels aligned with your goals. During the bear market, investors should do the following. First, avoid panic selling. In a bear market, when prices fall sharply, the instinct to sell and cut your losses is strong. However, history shows that markets eventually recover. Panic selling often leads to locking in losses and missing the rebound. Instead, focus on your long-term plan and avoid emotional decisions based on short-term fear. Second, focus on quality investments. Bear markets test the strength of companies. In these times, it's safer to invest in high-quality companies, those with strong balance sheets, consistent cash flow, and resilient business models. These firms are better equipped to survive economic downturns and bounce back during recovery phases. Third, look for opportunities. While bear markets are difficult, they also present opportunities to buy solid stocks at discounted prices. If you have a long investment horizon and extra cash, consider gradually adding to your positions. This strategy, known as dollar-cost averaging, lets you invest steadily while prices are low, potentially boosting returns in the long run. Last, review your emergency fund. Before making any new investments during a downturn, make sure your emergency fund is fully stocked. A healthy cash reserve, usually 3 to 6 months of living expenses, provides peace of mind and flexibility if income becomes uncertain. You don't want to be forced to sell investments at a loss to cover urgent expenses. Section 4. Warren Buffett, a masterclass in bull and bear market strategy. When it comes to long-term investing, Warren Buffett, the legendary CEO of Berkshire Hathaway, is perhaps the most respected and widely followed investor in the world. During bull markets, when stock prices are rising and investor confidence is high, Buffett is known for staying rational and avoiding the hype. Rather than chasing hot stocks or speculative trends, he focuses on buying quality companies at fair prices. His famous saying, "Be fearful when others are greedy, and greedy when others are fearful," reminds investors not to get carried away when markets are booming. For example, during the tech bubble of the late 1990s, Buffett refused to invest in internet companies that he believed were overvalued, even as others made huge short-term gains. While he was criticized at the time, many of those tech companies later collapsed. Buffett's disciplined approach helped him avoid major losses and protect long-term capital. In bear markets, when prices fall and fear spreads, Buffett doesn't panic, he sees opportunity. He often uses downturns to buy great businesses at bargain prices, taking advantage of widespread pessimism. During the 2008 financial crisis, for instance, Buffett made bold moves by investing in companies like Goldman Sachs, Bank of America, and General Electric, when others were too afraid. Many of these investments earned him billions in profits when the market recovered. In more recent downturns, like the 2020 COVID-19 crash, Buffett continued to apply the same philosophy: keep a strong cash reserve, wait patiently for the right opportunity, and only invest in companies with durable competitive advantages. Section 5, Conclusion. In summary, a bull market is when stock prices are rising and investors are confident, while a bear market is when prices are falling and fear takes over. Both are normal parts of the market cycle and can teach valuable lessons about risk, patience, and discipline. Whether you're dealing with a bull or bear market, the key is to stay informed, stay calm, and think long-term. Successful investing isn't about predicting the market perfectly, it's about managing your money wisely in all types of conditions. That wraps up today's topic. If you found this video helpful, don't forget to like, subscribe, and leave a comment below. Thanks for watching, and I'll see you next time.